From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Welcome, and we're back on the COB once again for another day. I had a day off, came back nice and fresh, and here we are this Wednesday afternoon. Danny, aka of course, Kyle Rodder, market more or less flat.
Just trying to check in and see where it ended.
Yeah, no,
I
certainly.
forgot to log in.
Well, yeah, of course. Well, I'll take the reins here just very quickly, and it bounced around a little bit today, but up by a downside very marginally by 0.03%. That's where we went into cash trade, 73.20 down 2 points. So we'll see how we fare throughout the post-market auction. It has to be said, we did bounce off the back of those CPI numbers. So
we did, and compared to the US performance, it's actually pretty credible here in Australia, isn't it? Because the US had its first big tumble in quite a while, but yeah, a few of the punters look like they've taken heart from what seems to be a better than expected inflation rate. And I think those energy stocks were a little bit firmer today, and that might have been off the back of what our Treasurer did, I think, in terms of changing the cap on gas prices or loosening it up a bit.
Yeah, so we did see the energy sector higher for the day. We'll crisscross those just in a moment's time perhaps, but we'll get to the three themes as we always like to do. Inflation falls, RBA pause. Well, I suppose there's a very good chance the RBA will keep policy on hold at least in May as well. Market's still betting on that there might be another 25 to go, but nevertheless, May looks like it's likely to be another hold. Miners drag the market though. Production reports, material sector down about 1.16%.
Yep, and I was reading earlier today that those Singapore iron ore futures sub 100 US dollars 100 a ton. So yeah, a lot of weakness there, and it looks like that might continue. Certainly speaking to some of the experts, there is the view that we could continue to see weakness with those big miners. And obviously those US banks, we might touch on that a little bit more with our guest today, but it's looking a little bit honky over there with some of those regional banks. But as per usual, or not as per usual, more like as per usual recently, gold is shining again. Yeah. And the gold stocks, they were running full tilt today, weren't they?
They certainly were, and probably a good chance just to look at some of the sectors we wanted to trade today. We talked about the miners before, and well, down by across the board, it has to be said. Let's see if we can get that graphic up there, shall we? Just the miners, if we may, and here we go, wonderful. The big three down by a small margin, relatively speaking, but still significant. And like you said, Danny, that price, I think, pushing below $100 per tonne, if I'm not mistaken, at different stages, which, considering, you know, we were talking last week, it was $120.
Absolutely.
So, quite a meaningful fall there. But you can get a bit of a hint. We've already spoken about energy, but you just touched on gold. Newcrest Mining up by just shy of 2%. Let's see if we can get the gold miners up, shall we? And there we are, really strong across the board. Evolution Mining, the shining star there, I suppose you could say, up by 3.2%.
Yeah, absolutely. They all seem to be finding some love at the moment.
Definitely.
And what else have we got? Retailers,
just want to look at the retailers quickly too, because we actually saw a lift in the consumer staples, and albeit briefly, a lift in consumer discretionary after that CPI release today. It was what sort of helped propel the market back towards, well, effectively flat. It wasn't an emphatic move, but nevertheless, it was a sort of a 20-30 point move on the ASX 200 off the after those numbers were released. So mix there probably doesn't really convey the picture, but we did have staples up. We also had consumer discretionary up very slightly as well. So slightly secondary in terms of what was driving the market today, but still worth noting because that inflation number was significant. But well, also some corporate news today as well. I don't know if you had a great chance to get across much of it.
Sonic is big acquisition, aren't they, over in Germany?
In Germany,
yeah.
So
yeah, 258 million or something, I think I picked up.
Yeah, so it was down in the day in the end, but it was the report says that the acquisition will be immediately earnings accretive. So buying, you know, what could be considered a fairly profitable asset there, perhaps. But down, interesting too, because healthcare was up 0.2% for the day. Kogan announcing a share buyback as well. Yeah,
interesting. And obviously the investors love that. Actually, a lot of investors love a buyback, but clearly management feeling that it's just gone a little bit too far. So, yeah, rallying today. Is that really up 7% today?
Yeah, 7.2%.
That's a big one.
announced obviously a broader update as well, and still at a loss, I believe, that the business is running at the moment, but perhaps heading in the right direction. Maybe we'll get greater detail of that in a moment. Mineral Resources also out with a production update, and that was really quite negative. It wasn't, at least it was fascinating for me, because unlike maybe some of the other miners that reported or provided production updates last week, probably wasn't as clear cut as bad, but a couple of key mines there just sort of providing guidance, I think, at the lower end of estimates from what I saw. So I don't know, maybe that's behind the significant drop.
What caught my eye was the fact that its services division, mining services division, they said the work is really drying up there. And I thought that was really interesting, because a lot of experts we've been talking to have been very positive on that part of the business. So unless I misread it, that could be why it's taken such a big tumble. But having said all of that, I had a really interesting guest, Tim Buckley, on earlier, and we were discussing lithium prices and national security issues in this market. And, you know, the secular trends are really firmly in place for, you know, our lithium miners. So as there's this weakness coming through with the prices, you know, it may provide down the track an entry point for some investors.
Yeah, I suppose that's when the sort of cyclical factors diverge from
Very
that sort of
cyclical
plays, and you know, maybe it provides some opportunities if you're, you know, able to take them. But let's get to the stock of the day, actually, because Koshi was back on board at the helm, so it was nice to see his face around the office once again. But the stock of the day was Eagers Automotive. Have a look at what the guests had to say about this one.
A pretty good yield, about 5%. So I can go hold on the valuation. The chart is very, very strong, and that's certainly reinforcing this idea of holding. I could start to buy it again. It's not about what I think. I think, look, fair value a bit flat, but if the market likes it, that's all that matters to me. And if it starts to push above 14.50, then I could upgrade it to an add. So again, putting a toe in the water, putting about a third of what you normally put into your share positions, more of a longer term view on this one.
I'd agree with Carl. I think it's I think he was getting to a hold there, and a slight add. And I think that's right. You know, it's probably not quite cheap enough. The stock does move around quite a bit because Nick Politis owns such a large holding. It's actually very thinly traded once you strip out his ownership, and there'll probably be a time, I suspect, in the next 12 months you might be able to buy it a bit cheaper.
Okay.
Okay, so it was another one of those situations where there wasn't an emphatic, clear-cut recommendation there, perhaps, but they didn't mind the company. I think that point at the end, because it's just to let you behind the curtain, obviously, folks at home, but having a talk about, you know, why it sort of moves in this very interesting way in terms of price actions, or even say technicals. But that point by Ben Clark, really interesting. How is it Nick Politis owns so much of the stock that not much of it actually trades. So something to be wary of, I suppose. If
but they do have the sole distribution rights of BYD electric vehicles, which, you know, Nick Politis keeps talking up, and they are a very credible competitor to Tesla. So again, that thematic, can't help ourselves. We're back to EVs and everything associated with decarbonisation.
Of course, it's not going to go anywhere anytime soon. But before we get to our guest, how about we sort of perhaps chat about the view today? And I don't know, maybe you've been taking a walk around a few lakes, perhaps, because it's about whether something quacks like a duck or sounds like a duck. It is a duck, of course. What are the folks that I'm going to be reading about today?
Yeah, well, the duck in this case is a pending credit crunch in the US and a pending recession. And it's really interesting because someone on Twitter said, well, of course, a recession in the US is fully discounted, yada, yada, yada. Well, I tend to disagree because, you know, the markets haven't really corrected at this stage. Some stocks have, but not the big tech at this point in time. And I just did a little bit of listening to some podcasts yesterday, and I was trying to work out what on earth is going in at the short end of the US Treasury curve. And there's mixed views. Some people are saying that basically there is a pending liquidity crunch, collateral crunch, and these institutions are going in to buy short-dated T-bills because they are very secure, they can be used as collateral. And other people are saying that it is the pull forward in terms of the debt ceiling because tax receipts markets in the US have not been as robust, which means that the debt ceiling, the whole negotiation might be moved forward. But at the end of the day, the bond markets are making some signals. So it was kind of a little bit of diving in to see, excuse the pun, is the duck really a duck?
Is the duck really a duck? Well, I feel as though we'll soon find out, I suppose, or at least we will in time. But I've got all sort of images of Catcher in the Rye in my head of you sitting in a park just feeding the ducks as you ponder and listen to the podcasts on your Anzac Day, perhaps. A poetic image in my head. But let's shift on and let's get to our guest, shall we? Mark Gardner from Macro Capital joins us again. Mark, great to see you.
Good afternoon.
Wouldn't mind starting with a point of conversation that we picked apart a little bit on Monday, because we were talking about First Republic Bank, and your comment at the time was you don't normally push back your earnings report, because of course they were supposed to do so on Friday. By a couple of days if you've got good news to report, and lo and behold, it actually probably shook up the market a little bit.
Yeah, down 50% in the share price is pretty bad. It usually is a bit of a red flag, that sort of thing. And look, and as I said on Monday as well, they were focused on the level of deposits, or the run on deposits, which was worse than even the analysts expected. So yeah, it really was in that. Janet Yellen has really, set the tone there in saying, particularly with the reporting from the bigger banks, that there was not a run on deposits for those guys, because she sort of verbally backstopped them, but there was on the regional banks, which she did not verbally backstop. So probably a bit of an error from her, I would have thought, and why, I think in those situations, those government employees feel the need to come out and reassure markets, but unless you're doing it consistently, you actually end up just scaring markets, as the German Chancellor did with Deutsche Bank, which ended up being nothing, etc. So, even though she's been a past chair of the Fed, I think she should probably just stick to her lane, I think, in future, because I think it's probably compounded the problem quite badly. So they're looking at $100 billion worth of asset sales and trying to pretty much put lipstick on the pig so someone can buy them out, essentially. Otherwise, it's.
But who's going to touch this loan book? Because all the loans were written at effectively the wrong pricing compared to where loans are being written at the moment. That's what I keep on thinking. Like, recapitalising this bank is challenging. The share price is down.
In my opinion, I think they should let it fail, to make an example, because these guys can't keep getting bailed out all the time. Otherwise, we're going to have a 7 to 10 year cycle of these banks pushing the envelope, collapsing, and then the Fed or the Treasury turns around and bails them out. So, I think in the situation of Credit Suisse, it was probably being a prime broker globally, that with a lot of counterparty risk, that would have frozen the financial system up pretty badly. But a smaller bank like this, realistically, I think they can't keep backstopping, these financial institutions to roll the dice, and then the government covers you every time. Every time things go pear-shaped. So I think Signature Bank's out tonight. I think the regional bank ETF's down sort of 4 or 5%. In the last sort of couple of sessions. So I think, and tonight we've got Meta, Thermo Scientific, Thermo
Boeing, I think.
Boeing as well, which is a constituent of the Dow. So obviously Google and Microsoft sort of saved the day last night after the bell, and regained a lot of those losses in the Nasdaq. But interestingly, it was an uplift in their cloud services for both. We might see a situation where we quite often see Meta and Snap, their customers go back and forth. We got Amazon on Thursday, where this uplift may not be an expansion in the actual market or the uptake of the services. It might actually be at the expense of Amazon, which rallied with them. So it'd be one to look out for, because it's a considerable. Like, the actual shopping part of Amazon is such a small part of the business now that AWS is the lion's share of their revenue. So it'll be interesting to see how that plays out on Thursday night as well. So, but there's still lots to watch.
Yeah, I'm going to say, and I've got a tongue-in-cheek comment to make about Janet Yellen. Maybe First Republic speaker fees aren't quite high enough, so he doesn't want to,
Oh, wow.
Yeah, I know. I had to chuck it in there.
Just meant to be me.
For humorous effect, but kernel of truth. But no, if we are sort of focusing once again on these bank stability risks, does this start washing out the earnings story, even the inflation story to an extent again, because we go back to worrying about the stuff that we were at the start of March, which is these systemic issues that we can't necessarily diagnose with any level of certainty yet?
Yeah, the contraction of money supply is a massive issue, probably further to your, what's going to be written in the View today. And we haven't had a serious contraction in the money supply for decades and decades and decades. So, we're going to have to cope with it. I think, from a broad perspective, even if there's like 12 months of pain, I think it's better than what central banks have done over the last decade and just kick the can down the road and make the asset bubble eventually worse. Mm-hmm. So, COVID was obviously, was very annoyingly timed because it was a very orderly unwind of that leading into 2019. And then with the uncertainty around COVID, both, government spending and, and monetary policy was, both barrels of the gun there, flushing the money, flushing the economy with money. So, yeah, we do have to sort it out at some stage, and because inflation down the line is much more damaging. Mm. So, I wouldn't be surprised if central banks try to break something, and then post manage it a little bit because. You don't want a situation where inflation sticks around, because stagflation, where we have slowing economic growth and higher inflation, that's a disaster for equities. I don't think there's ever been a rally in a stagflationary environment. There's been very few of them, but it's not good for equities overall. So the short-term pain of the Fed or central banks raising and getting really aggressive is probably much better on a 18-month to 2-year time frame than letting them space it out over a long period of time and possibly causing an even bigger downfall.
It's really interesting because I've been picking up on, again, quite a lot of experts and the views around inflation. I mean, they are just so polarised, aren't they? I've got really big experts out there, whether it's David Rosenberg or, some other really big guys, and they're all like, it's going to be heading easily down to that 3%. And then obviously there are others saying stickier. But maybe just transposing what's going on in the banks in the US, not to the strength of our banks here, but that competition. You touched on that briefly for our Aussie banks in terms of the competition in the deposit market, competition in the mortgage market. We've got 3 banks reporting next week. So if we step back and say, okay, if the US kind of wobbles, Australia's 2 largest sectors in the ASX, banks, not so much the other financials, insurers, will exclude those, and the resources, it's all looking like there's a few headwinds coming in there.
Absolutely, yeah. Iron ore's dropped sort of 11-12% in the last week. I still think those big miners are way overpriced. And look, I mean, MinRes fell back quite considerably today. I mean, they were a little bit unlucky. They picked a pretty bad time to release. I don't think that result was anything out of the box compared to any of the other quarterly updates realistically. They've got the benefit that they're shifting resources from that mining services into some of their joint ventures. So at least they can park those assets, assets to be doing something constructive while, obviously that picks up, but it's a lot of approvals and things that's holding back those new contracts. It's not, there's work in the pipeline, but until those approvals come through, it doesn't really, it's not going to kick off. So, but yeah, it really is. I mean, the banks particularly, share prices generally only go up when credit is expanding. And I've done back testing sort of mid-90s, and that was the most reliable correlation, and credit's been expanding. It's expanded 600% in Australia since 2001, and it's going to pull back. So I would think that those banks realistically have got at least a good 6 to 12 months ahead of them where it's going to be tougher conditions, and you'll probably pick up some bargains. So yeah, that's where I've been consistently saying lately, it's not a bad time to sit on the sideline. And you're right about the inflation data. Like, you can get really credible, strong experts for both sides of the argument at the moment. And you know, if people are so split, and really smart people are so split, then
heaven help the poor retail investor.
Well, that's where I'm putting up my hands and going, if they don't know, I'm a fool to think that I'd know. So and you know, you can get paid to sit on those sidelines at the moment, because the good thing about a credit crunch or tightening money supply is you're going to get higher returns in risk-free assets. So you know, it's I think it's a really good time to be patient overall, because you know, I don't see it rallying from here. There's too many headwinds. And I think that those mega caps in the US are really disguising a lot of the broader weakness, and they will eventually succumb as well. But they're a bit more cashed up and a little bit ahead of the game in getting rid of staff and things like that. So, but yeah, we shall see what happens. But May, I think the consensus is down 7% or something from analysts for the S&P US analysts in May. So, which I think's, you know, a little bit eye-opening, but you know, we'd only really be going back to where we were at the start of the year.
Exactly.
So,
Might be a good place to leave it, actually. It was a good comment. Mark Gardner, Macro Capital, appreciate your time.
Cheers.
Okay, well, we'll push on. We'll just have a look at what's coming up overnight, and sort of had to dig around a little bit, because I think Meta and, you know, we spoke about Boeing before as well, probably the two biggest results, bookending the day's trade. Boeing's coming out before the bell. Meta will be able to wake up to that tomorrow morning.
Yeah.
US core durable goods is probably the top of the macroeconomic calendar, so nothing too sexy there, but certainly those earnings numbers will be significant.
Absolutely.
Yeah.
PCE on Friday, so people are probably hanging out for that one, I suspect.
Yeah, that'll be the big climax of the week, perhaps there. To the leaders and laggards, and let's take a look at what finished at the top of the table on the market today. And well, there's a theme there.
Yeah, exactly. Yeah, really, with the exception of New Hope and Stockland. So Stockland reaffirmed their guidance and basically said, you know, the housing component is still doing quite well. So that was up about 2.5%. New Hope had a bit of a rally as well, but those energy stocks were firmer today, including the coal stocks. I think West African Resources also had an announcement, their results today. I stand to be corrected, up about 2.8%, and Gold Road taking the lead at up 5%, and Evolution Mining up almost 3.2%. So gold stocks again back in favour, with a little bit of support from the gold price overnight, but obviously concerns about the banking sector. Not the big banks in the US, need to separate them out really clearly. It's the regional banks, and not all regional banks. But yeah, a bit risk off.
You wouldn't want to be the second Australian journalist to potentially spark an international bank run, of course. Let's go and have a look at the laggards now. And there we go. Mineral Resources, we spoke about it before, down 9%. So again, it just seems to be one of those things where disappointments are being sort of punished at the moment in these markets.
Totally.
So 9% is pretty significant for what was, I think, delivered. You also made that really good point before, that the devil is often in the detail, and some of those commentary around mining services.
Although, as Mark said, it's deferred, you know, delayed, but it's not cancelled, and that's kind of important there. A2 Milk down 5%. I think that was off the Synlait downgrade in terms of earnings there. Pilbara just caught a little bit of MinRes's profit taking. I'm not aware of any news on that one, because it rallied quite hard, I think, on Monday.
Yeah, it was up there on Monday, up sort of 5%. So just, you know, we're talking about the funny money that goes through the markets in that space. One thing I can offer light on is the irrational behaviour of retail traders sometimes. So if I can count myself amongst that group, and been very, very close to them. Love trading those lithium names. So plenty of momentum on an intraday basis. Not much on BrainShip there from what I could tell. Just a big move from a volatile stock, obviously 38 cents. So down by 6.17%. And drumroll please, time for the small caps, and let's see what's been moving at the lower end of the market. Well, ImpediMed was there the other day.
And 4D Medical is back again as well. That was one that we were talking about, I think, a couple of weeks ago, having rallied. I think they got a contract. I don't know what's going on with ImpediMed. And then we've got Melbana Energy up 15%, Galileo Mining up 13%, and Centrex up 11%.
And Galileo is a company that we've had on the show before. Nothing that I can see here in terms of news, but of course, could be anything 13% or so. Nothing in the news that I can see today. Let's go, if we can, to the laggards in the small cap space now. And we might not have that graphic. No, not working. That's okay. We'll move on from that, and I suppose that kind of takes us to the end of this.
Goodbye, adieu, au revoir.
Danny's the cultured one here. I'm just a boy from the burbs in Melbourne, unfortunately. But yes, we will say farewell, Avita saying.
Exactly. There you go. Avita saying. Yeah.
I've got the girlfriend in Germany at the moment, so I've got to try a few tricks. But sort of a negative day for the market. Those gains for CPI.
Actually, I think it's quite positive on a relative basis.
Well,
we could have been off, 1% or something. So I think the little Aussie market. Sorry, it's not a little Aussie market. It's a big Aussie market.
Yes.
But I actually think on a relative basis, it actually did quite well. And it's all about relatives at the moment, isn't it? Relative percentage moves.
Absolutely. Well, it's a good place to end that too. Well, remember, catch up on all the views and interviews on our website and app. Have a great night, and we'll see you tomorrow morning.
The COB is brought to you by eToro. Invest in ASX shares with $0 commission.